All right, so one of the first things I want to talk about today is our IBM assignment from last Wednesday. So if you remember, on Monday, IBM announced some really disappointing earnings to the marketplace. And there were kind of two themes that were in the links that I gave you for the assignment last Wednesday about the earnings. Number one is they basically said growth isn't going to be as good as they thought. And one of the challenges is that since the current IBM CEO took over almost 2 years ago, they have shrunk every single quarter that she's been on the CEO side. And worse, they're expected to continue to shrink, right? And that's put a lot of pressure, unexpected, on the stock price because IBM is actually in a market, if you look at it, that's growing. That was what the IBIS World Report said. They're actually in a really good market. And Warren Buffett invested in them over a year ago, saying that they have some really good long-term growth prospects, and they're shrinking. And that's surprising the marketplace. The other thing IBM did that disappointed the market is they sold off their chip business, which, again, sold off is an interesting word because they're actually not getting money for their chip business. They're actually paying somebody $1.5 billion to take it off their hands. And I think that surprised the market as well. So basically, there was just some unexpected negative news, hurt the share price to the low 160s. So as part of our as-is valuation, what we're trying to understand is why. What were some of the assumptions? And as we talked about, the key assumptions are growth, margin, tax rate that the market must be making in order to come up with this price. So what we have here on the screen is a submission by one of the students who's bravely been coerced into coming up and talking about how they made these assumptions and why they made these assumptions that got to this share price for the as-is. So if you want to kind of come up, say hello, and just kind of go through. Thank you. It was encouragement. But what was some of the changes you made and why did you make them?
All right, so one change I made was the tax rate. So for the most recent year, the CEO announced that he was going to lower the tax rate to soften the blow of the underperforming earnings. And so for 2015 and onward, I made it at 15%. The tax rate is going to be at 15.
Is a she, by the way? Yeah.
Oh, she is like 15 something percent. So I made it at 15% in 2015. I just increased it by 1% because I didn't think it would remain that low for a long period of time. And then the other thing I changed was the revenue growth rate. So if you can see, they mostly had negative growth for most of the years. I think only 2 years they had positive growth. But I was a little bit optimistic, and I only made the negative growth about 1.3%. So it's a little bit optimistic on my side. EBITDA didn't really change that much because I didn't see, there wasn't much evidence of it changing drastically.
But it does start to go down in like 2019.
Yeah. I mean, I made it relatively the same as this. But like if you can see in 2019, it's still at 24. But if you look at here, the average is only, the average is, 25? I was on averages, but it's around like 23, 25. So it's really not much of a change. I got operating cash percentage of revenue. It's pretty self-explanatory. Operating cash over revenue. Is there anything else you want me to talk about?
No. So the gist, and thank you for that, by the way. But the gist of, I think, what you're saying is that to get to the current share price for IBM, there's really two assumptions that are at work here. Number one, they're not really growing in the future. In fact, you expect them to continue to shrink, which is going to be a real challenge for IBM. And number two, that they'll maintain their margins for a couple of years, but then they'll shrink a little bit more. All right. Now, as I said, some of these scenarios could differ between what we do, but I want you to remember this comment in about 25 minutes. All right. I want you to remember these assumptions that were just made in about 25 minutes. Because when we talk about multiples, one of the things we're going to do is we're going to triangulate what the market is telling us from the multiples as to how we put assumptions into the valuation, which, by the way, is going to be part of your next exercise that you're going to have to do on Wednesday's homework for Monday, is you're going to have to get into this part of the process, right? Because this will help you. And by the way, what I'm going to show you is something that most people don't know how to do. And if you're actually interviewing with a bank, will impress the hell out of the bankers that you can actually figure this stuff out. And it will really differentiate you from most other finance students. So let's talk about multiples. So I posted yesterday the multiple lecture note that we're covering this week. So, keyword, multiples, also known as comparables or comparables, depending on how you want to talk about it. But it's basically, what it's doing is it's looking at the price for similar assets, and it's looking at how much people are going to want to pay for those prices as a way of doing benchmarking. So to be honest with you, you do multiples every day. Because if you walk into a store and you're trying to decide whether or not something is trading at a fair price, that is a multiple analysis. You're doing a comparable because you're saying for that item, I can pay this price here, or I can pay a price for something else that's about this. You're trying to look at value against different items, or at least across stores. All right, so we're really doing the same thing with stocks, right? Matter of fact, the most common multiple you run into in the real world is if you ever buy or sell a house. Because in order to buy or sell the house, you're going to have to get an appraisal. What the appraiser is going to do is a multiple. They're going to do a price per square foot multiple, where they're going to look at how much have similar houses sold for in the last 6 months, what was the square footage of those houses. They're going to divide that, and they're going to get an average price per square foot of an area. But then what the appraiser is going to do is they're going to also adjust that price per square foot up or down based on some other factors for the house. So what might be some of the other factors that would cause the appraiser to take the price per square foot up or down from the average for the area? What could have impact that for your house? Yeah.
Prices per square foot of other houses in the neighborhood nearby.
So what would cause the prices per square foot to be higher or lower?
If prices were higher in the area.
So prices were higher. What would cause the prices to be higher? What are some of the factors about the house itself that would mean the prices would be higher per square foot? Yeah.
Just like amenities that the house might have.
Yeah, so for example, what's the amenities of the house? And I'm repeating this just so we can hear it on the audio.
Let's say it had a pool or something like that.
That's right. Does it have a pool in the backyard? Does it have a multi-car garage? I had a friend that was looking for a 4-bedroom house recently. 4-bedroom house, 1.5 baths. He's got 2 kids. All right, you can laugh about that one. That house was trading at a discount because nobody wanted it. Right, just not enough bathrooms. Right, or location. What's the location of this house? Is it on a corner? Is it on a cul-de-sac? Is it in a good school district? Is it in DC versus the suburbs? All will affect what's the taxes of the area. Or another way of looking at it is size of lot. Is that a little tiny lot? Is that on a third of an acre of land? Is that on an acre of land? That will affect the price of the house. Age and condition. So is the house brand new? Does the house have problems? Because it's really old and needs being fixed up. Here's the point. When we do multiples for companies, think enterprise value to EBITDA multiples, or if we do a price to earnings multiple, the same thing applies, right? And what we said is there were 3 factors that generally affect multiples when we did key value drivers. 1, growth. 2, ROIC. 3, cost of capital, risk, right? But there's a few other factors that matter as well. Tax rate, capital structure, and therefore interest, non-operating gains and losses, one-time items, plus non-operating items. So to be honest with you, those are the other factors that drive multiples, right? But regardless, the point is that what it really does for multiples is it replaces discounted cash flow as an alternative means of valuation. The reason why the market likes multiples, it's easy. Figuring out the DCF is hard. Figuring out the multiple is really easy. Matter of fact, the other reason they like it is because it's based on actual prices paid. When we just did IBM, we came up with a theoretical value in a spreadsheet. When you do a multiple, you look at the actual price somebody has paid for something on the marketplace today. So, in a way, we can argue about the theoretical value, but multiples are based on actual prices. Right? That's why people like multiples. The problem with multiples is that they're simplistic, right? Meaning we're using one number to represent a lot of variables, right? And it can oversimplify things. But number 2 is, believe it or not, the biggest challenge with multiples is coming up with a comparator group, like figuring out what the peers are. That's the hardest part of multiples. And I'll give you an example of that. So last week, Amazon announced their earnings. Does anybody know what happened? Yeah. What happened?
Stock price plummeted.
Why? Why did the stock price plummet for Amazon? Yeah, there was disappointment on the revenue, and there was an unexpected operating loss. So they ended up losing a lot of money when everybody thought they were going to kind of break even, and they also didn't grow as fast as they thought. So there was just an unexpected earnings surprise. But it caused the stock price to kind of plunge, and it's been going down recently, right? But here's the point. So we want to then do a multiples analysis. So let's compare Amazon against the peers. Who are we going to compare Amazon against? What peers are we going to compare? All right, Walmart or maybe Best Buy, some retailers. eBay. Matter of fact, there's another big one that just started trading. Alibaba. Who else do we need to compare Amazon against? They not only sell goods and services. What else does Amazon sell?
Tablets and phones.
Tablets and phones. So maybe we want to throw Samsung or Apple in that list. And what's their other big part of their business? AWS. Amazon Web Services.
Oh,
So like
Netflix.
cloud services.
Do you realize that Amazon today is probably representing 30% of worldwide internet traffic at any point in time today? And go back to Netflix. Most of it's because of Netflix. So if you use Netflix, you're actually using Amazon. It's private label. Matter of fact, if you use if you use Dropbox, you're using Amazon. Private label. So they are the cloud-based infrastructure providing a lot of data services. They have the biggest cloud in the world, right? So that's the other point. Who would Amazon look at as competitors for the cloud? Microsoft, IBM, who we just talked about, and another big one, Google. Now, Apple. As of last week, Apple's now getting bigger into the cloud. Everybody's going to the cloud. So these are the comparators that we're going to want to look. But notice what we just did. We're now comparing Walmart, Apple, and Alibaba. Are those real comparators? We start putting those three companies on the list. So to compare with Amazon, we have to do it. But when you start putting that list together, what you realize is you created this kind of Frankenstein list, which is actually difficult to really justify as true comparators. And so that's the real problem we have with multiples, is finding in today's world. Now, when Harvard Business School did it in case studies that you did in other classes, they were extremely selective about industries that had pure play competitors. Like if you ever did the Marriott case, there were 6 hotels that all they did was hotels, and this was 20 years ago. Today, even hotels don't do the same thing that they've used to. They're in all these other separate businesses. So that's the point. Finding true comparators is hard. So even though it's simple to think about as a concept, that's the most challenging part of the multiple analysis. And so what matters is what you really want to find are companies that have similar growth rates, similar ROICs, and similar capital structures. So here's what I mean. Even comparing Twitter and Google is problematic because Twitter is a young company with a very high growth trajectory ahead of it. Google is a far more established company that's not going to grow nearly as fast. So you're going to see an apple and an orange between their two multiples just because their expected growth rates are far different. Okay, so putting them together on the same page as multiples could be hard to come up with a true benchmark for the industry. Not saying that people don't do that in the real world, but that's one of the limitations we quickly find with multiples. So the other part of doing the multiples is doing the analysis. And this is part of your homework assignment that's coming up. But the first step is to establish the range of companies. Right? So we'll talk on Wednesday about which companies we need to put in our multiple analysis. Second, we got to get the data for the multiples from a data service. And specifically, the reason we need a data service is we're going to care about forward multiples, not historical multiples, because we care about expected cash flows. So therefore, I care about expected sales. I care about expected profits because those indicate expected cash flows. So you need a pro data service in order to do that. That's why we're going to use Bloomberg. Next, we have to calculate the multiples based on those expected earnings. Here's the nice feature of Bloomberg. It does all the math for you. So I'll show you how to create the templates with all these expected earnings already done. Make your life a little bit easier. And then we got to try and explain things. Now, the other thing that we'll use multiples to do is something called precedent transactions, right? So if you work for an iBank, this is a lot of what you do if you get into either M&A or investment banking. Because what you'll have to do is somebody wants to sell a business to somebody else. So what you'll do is you'll look at all the multiples on deal comps, kind of like the price per square foot, and basically figure out what is a fair price based on those multiples. Or you have a private company, you want to take them public. You got to figure out how to price them when they go public based on what the trading range of public companies that are similar would trade at and inferring that against a private company. Matter of fact, Bloomberg is a terrific data service for doing precedent transactions. So not that that's a focus of ours this semester, but I'll give you an example. In Bloomberg, the short code is MA, which stands for Mergers and Acquisitions. So this is a database of 26,785 deals that have been done, right? And what I could do is I can look at deals that were announced today. So basically, potential buyer has got this company, Azadia, that must have just been announced. 3i Group is buying this company. So basically, these are the deals that were announced today. Or I can also do here on advanced search and do check off uncheck investments as opposed to M&As. But I can do advanced search and I can also start doing my own criteria. So for example, let's say that I wanted to go into a specific sector and I wanted to look at utilities, and I'll just do utilities in general, which are 12,969 deals. And I want utility deals that have been done in specifically the United States. And I want the date range to be in the last year. And I want it based on the announced date, down to 267 deals. And I want a deal size between 1 billion and 5 billion US dollars. 17 deals. I click on this, click on results, and these are the 17 deals that have been announced. So for example, this company Enbridge has a pending deal to buy Alliance Pipeline for $1.6 billion in cash. So what I can do is I can then click on the deal, and then here's all the data associated with the deal, including prices and things like that. But one of the things Bloomberg also tracks is something they call the deal comps. So that's the point. Here are the precedent transactions. These are the purchase prices, the total value of deals. Now you notice the date range goes well beyond a year, but that were basically used to come up with a median deal price, median, and TV is enterprise value. Total value is enterprise value to EBITDA. So there's how much you pay to EBITDA, how much you pay to EBIT, how much you pay to sales or revenue, how much you pay to assets. So the average deal is 10 times EBITDA, 17 times EBIT, 4 times revenue, 0.75 times assets. All right? So this is my starting point. Right? But I could even quickly see that there's this company which looks like an Indian company, Cairn India, which was purchased at 104 times EBITDA. Well, that's a complete outlier to the rest of the data, because even though the utility that were purchased in this deal size, the problem is I'd be willing to bet that this is either a tiny company or somebody not making money. So that's the point. Early stage company versus a later stage company that I'm paying 4 times earnings for that doesn't have the growth prospects, it's going to have a completely different multiple, apple and an orange. So, for example, one of the things I'd probably want to do is I'd want to throw this company out of the comp list, because I don't think that they're a true multiple. I don't think they're a true comparator, because the growth and ROIC are so different that I'm probably not going to get the right type of deal price. Right? So this is what we're going to have to get into in the multiple analysis. Right? Just a little bit of a preview. But let's go back to our PowerPoint here. There are 6 multiples that you're going to be responsible for this semester. They're on this page. The price to earnings multiple, also known as the PE. The PEG ratio, which is the PE divided by the growth rate. 3 enterprise value ratios, enterprise value to sales, enterprise value to EBITDA, enterprise value to EBIT, and the price to book multiple. Those are the multiples you're going to have to calculate and explain for companies, including your group projects. So to better understand the multiples, I want to start with the key value driver equation. We did the key value driver equation earlier in the semester, and we've been talking about it a lot. But basically, this is a table where I put some assumptions in for the key value driver equation. So profits of 100, no plat of 100, 10% cost of capital, the WACC, and then at these G's and these ROICs, this would be the solution of the key value driver formula. Okay, just all laid out here. Right? Now, just to check our understanding, if you look at this column, 10%, in fact, I will use the pen here. Look at this column, 10%, getting fancy. Why does it stay 1,000 as the growth rate goes up? So at 10% ROIC, regardless of the growth rate over here, why does this stay 1,000? Why is the value, the result of the key value driver, not changing? Yeah, zero spread. We talked about that, how zero spread equals no value creation, and that's what you see here. So really, why are these numbers going up exponentially? Positive spread, grow positive spread, value goes up a lot. Negative spread, grow, destroy value a lot. That's what the table is just giving us a visual representation of the key value drivers. Yes?
So even if it's at ROIC 16 and growth 5%, if growth went up to 6%, the enterprise value would increase, even if that's decreasing the spread between ROIC.
Well, we can look at that trade-off. We can actually build spreadsheets, and this is what you're going to have to start doing as part of your multiple analysis to show me what the trade-offs are at different growths and different ROICs and how that affects value in multiples. But we can actually model that out, right? But intuitively, if I maintain my spread, it's positive, and I grow it, I should have a higher result.
Okay. Even if the spread gets lower because you're increasing growth.
Well, that's the thing. If I grow it and the spread starts to change, then I have to see. Then I have to see what the trade-off is. But if the spread stays the same and I grow it, I'm more valuable. If the spread stays the same and I shrink it, I'm less valuable. But then what I have to start to understand is it's the growth return changes that matter, which is the exact insight of the next slide. So here's the point. A $100 no plat is the same at a 35% tax rate as, my pen here, $100 no plat at a 35% tax rate is 154 of EBIT. Enterprise value to EBIT. Take the enterprise value, divide by the EBIT, and you get this table. That's enterprise value to EBIT. Right? So here's the thing. Why does the enterprise value to EBIT stay at 6.5 as I grow? Zero spread. Same concept. So here's the analysis. Think about it this way. This hypothetical company has an enterprise value to EBIT of 7. Another company has an enterprise value to EBIT of 6. What can we say about those two companies? One company has enterprise, so company A has enterprise value to EBIT of 7. Company B has enterprise value to EBIT of 6. What's the difference between those two companies? Why is one trading at 7 and the other trading at 6? What can we infer? I'm sorry?
B has a higher EBIT.
It has nothing to do with the size of the EBIT, because this is the multiple of the EBIT. Now I'll give you a hint. Where do we see 7s on the table?
Oh, above.
Here's a 7. Here's a 7. And somewhere in here would be a 7. So if I think about where my enterprise value to EBIT 7 range is, it's somewhere in there. What are those growth ROIC combinations? 12% ROIC is at what growth rate? 14% at what growth rate? 16% at what growth rate? Somewhere between 1 and 2. What can I infer about the spread of a company trading at 7 times EBIT?
They have a higher ROIC than.
Well, number one, I can assume that the company B has a higher ROIC than the WACC, so their spread is probably positive. What about the company with an enterprise value to EBIT of 6? Where are my 6s? Here's a 6. Somewhere in here is a 6. And obviously tailing down here. So it's going to look a graph more like that. So here's the point. Where are my 6s? They're on the negative side, negative spread side of the equation. So what the market is telling me, and this is why, to be honest with you, to really do this analysis, it helps to actually do the key value driver equation to figure out what assumptions, kind of like you just did last week, showed me a 6 versus a 7. Because very quickly, I could see if these two companies are growing at the same rate, one has a higher ROIC than the other, one is being priced with a positive spread, one is being priced with a negative spread. That's what we need to start to understand, that there's a story behind the multiples. It is just completely naive to just say, take a bunch of enterprise value to EBITs, average them out, multiply by the company, and that is your result. All right? That's not going to get you a job on Wall Street. All right? I'm not saying that that's not where you start with the process, but why is one different than another? So to help you start to understand this, let's talk about the PE ratio next. So what's the difference between enterprise value and PE? Well, enterprise value multiples are based on NOPLAT, which is another way of saying it's based on free cash flow. PE multiples are based on cash flow to shareholders. So what's primarily different is the cash flow to shareholders. We can use the same formula, but switch out the values. Now we use net income instead of NOPLAT, because net income is the cash flow to shareholders. NOPLAT is the cash flow to the debt and the equity holders. Return on equity is the return to the shareholders. ROIC is the return on the debt and the equity. Growth becomes growth in net income, because instead of growing the cash flow, we're growing the earnings per share, and instead of a WACC, the risk of the debt and equity, we just look at the risk of the shareholder money in the firm, cost of equity. So what I'm saying is we can apply the same principle and just look at the equity side of the cash flow. That's what PE ratios are about. So here's the point. If you plug those numbers into this equation, what you get is an equity value as opposed to a enterprise value. Okay? If you use ROIC and NOPLAT, you get enterprise value. If you use net income and return on equity, you get equity value. Right? So here's the point. If I have $100 worth of income, the cost of the equity, not the cost of the capital, is 10%. Right? Then plugging through that equation on the previous slide, plugging through this equation, we get this table. Growth in earnings, return on equity. Same concept. 10% return on equity, 0 spread, same value. Positive, negative. When we divide that by net income, so we divide this equity value by net income, we get the price to earnings multiple. So let me ask the question in a different way. PE of 12, PE of 9. What's the difference between a 12 and a 9?
12 is positive spread.
12 is positive spread. 9 is
Negative.
probably a negative spread because 10 is break even. So what I'm saying is when you see a PE in the real world, now here's the thing. It depends on the cost of capital. Because if I didn't know the cost of capital, I wouldn't know what the spread was. So I would have to put in some simple math to get an assumption of a baseline PE. But if I really knew that for the industry, then a PE can tell me a lot about the industry. Right? So that's what I said. Understanding the formulas behind the multiples is really key. By the way, this also gets me a price to book multiple. Now, price to book multiple says how much am I paying, market price, share price, divided by how much equity did I originally put in the firm. What's a price to book multiple of 1? Looking at this table, what's a price to book of 1 tell you? They're dead even, which means what? Zero spread. So price to book multiple is a way of expressing spread. You create value. You have a price to book above 1 if you have a positive spread. You destroy value if you have a negative spread. Okay? So I work with Spanish banks. And I work with BBVA and I work with Santander. And doing valuation for banking is very specialized. It's kind of a similar process. Just imagine you have no data that you can actually analyze, and then you actually have to figure it out anyways, because banks are very opaque. But that aside, it's an equity valuation. So let's just say I go to today and I look up BBVA, which is a Spanish bank. And I want to look at just the Spanish banking market. So I'm going to compare BBVA against the publicly traded Spanish banks. Now, here's the thing. I go into the custom screen, and this is what I'm going to show you how to do on Wednesday. But I'm going to look at the price to book multiple of the Spanish banks right now. And I'll use select stats to do a market cap weighted average. So here's the price to book multiple of the Spanish banking industry today. All right, remember, price to book is based on return on equity against cost of equity. It's spread, but it's the equity spreads. What can you tell me about the Spanish banking industry? Is it creating value or not? You think so? Does the market expect the Spanish banking industry to create value? Yes or no? There's a right answer to this question. How can we say it's yes? Because the price to book is 1.1. Now, it's not that far ahead of 1, so it's probably not a lot of value, but there is some value being created. Banco Popular, one of the big publicly traded cajas in Spain. What can we say about Banco Popular? They probably have a negative spread. All right, so that's the point. I don't have to tell you what the return on equity is. I don't have to estimate the return on equity, but you've already given me some insight into the Spanish banking market today based on what the professionals must be thinking about these banks based on how their prices are actually traded today. Now, BBVA. What can we say about BBVA, which is the first bank here? They probably have a positive spread. Banco Santander, largest bank in Spain. Who has the higher expected ROE? All right, so here's the point. I'm going to do BEST, which stands for Bloomberg Estimate. Okay, remember the earnings estimates? I can pull individual data, and here is the best ROE. Okay. And what I'm going to do is a blended forward 12 months. So these are based on the next 12 months of expected earnings. Here's the expected return on equity for these banks. Banco Popular, 4%. BBVA, 8.76. Banco Santander, 8.45. What I'm telling you is even before you saw those expected returns on equity, the price to book told you what we were going to see. And so that's what I'm saying about multiples. Multiples have a lot more data if people truly understand how to understand them than people really realize, because it's the end result of an equation. And we can work backwards to figure out what had to go in the equation. So it's not too dissimilar process than what you did with the IBM assignment we're doing with the multiple assignment. And we have the key value driver equation, which doesn't have that many items in it, and most of them are available as earnings estimates from the market, so we can get a sense of what the market must be thinking and essentially back this out. So that's what I'm saying. When I look at numbers and multiples, I kind of know what to look for, and it's telling me a story. So let me tell you how I understand the story. Going forward. First, the pros prefer enterprise value multiples to PE multiples. Right? What is enterprise value multiples? Enterprise value is the cash flow to the debt and equity holders divided by EBIT, which is the profit to the debt and equity holders. Right? Why not price to earnings? Price to earnings, the difference primarily says, forget about the debt, and look at the value of the equity to the value of the net income. Equity to net income value versus debt and equity to EBIT value, right? That's the difference between PE and enterprise value to EBIT. Now here's the thing. What gets us from EBIT to net income? How do we get there? EBIT to, what's between EBIT and net income on an income statement? One, tax. It's difficult to write with your mouse. Two, interest. Three, EBIT is actually after depreciation. So it's EBIT to net income, not EBITDA. So three, non-operating items. One-time gains and losses, extraordinary items, write-offs, things like that. So here's the thing. What drives this formula is basically growth, return, and risk, which is the WACC. I'm having trouble typing. That's supposed to be a W. Okay. So here's the point. When I do this equation, it's a three-factor analysis that primarily explains the difference. When I do PE ratio, it's these three factors plus these three factors, which means I now have to do a six-factor analysis to explain one number. So what's interesting about PEs is PEs are the most difficult ratios to explain because in addition to these three factors also influence net income. And so that's the problem with PE, is that you see much more distortion because of non-operating gains and losses, because of differences in capital structure and differences in tax rate than you do in the enterprise value multiples. Therefore, the pros like the enterprise value multiples because they're easier to understand. I'm not saying that non-operating items can't influence enterprise value multiple, but I'm saying it makes the analysis slightly easier because there's less factors that you have to control. Right? Now, with that aside, so how do we calculate an enterprise value multiple? Well, let's start out with our key value drivers equation. Here's the key value drivers equation on this page. Well, what is enterprise value to EBIT? I take my enterprise value, I divide by EBIT. What is NOPLAT? NOPLAT is EBIT times 1 minus the tax rate. Divide both sides by EBIT, and I get this formula over here. So enterprise value to EBIT is 1 minus the tax rate. So this, growth, ROIC, WACC. Those are the factors that affect value to EBIT. So that's what I really have to explain. Difference in tax rate, difference in growth rate, difference in ROIC, difference in WACC. If I chose peers that are the same industry, the differences in the tax rate shouldn't be all that great. If I chose peers that are in the industry, the difference in cost of capital shouldn't be all that great. So really, growth and ROIC become the primary differentiators. But nonetheless, these four factors create an enterprise value to EBIT multiple. Just to put this into perspective, on October 7th, knowing that we were going to do the Koch valuation model, I went to Bloomberg and I exported the EEO screen. Can we help you? You're in this class?
No.
We still have a classroom that goes on. You can come back in 5 minutes. Sorry, just give us about 5 minutes. So this is the earnings estimates for Koch as of October 7th. I just dumped it into Excel. As I said, this is the historical year and then 4 forward years. 2014, forward year 1. 2015, forward year 2. As the book talked about, forward year 2 is more important for more normalized numbers. So here's the idea. Using this formula that we just talked about and these earnings estimates. This was the earning estimate at the time for sales. This was the EBIT forecast. This was the tax rate, which I used the 6-year average tax rate, just like we did in class. So as I started to build the model, I looked at what that tax rate was. I then looked at the operating ROIC that our model showed us historically when we did the tree, right, to get a sense of what I thought the operating ROIC with Koch would be. And then here's the thing. I looked at Koch's actual enterprise value to EBIT which was 18.3 on enterprise value to EBIT on October 7th, 18.3. So what I actually did is I solved for the G that got me 18.3, 3.65%. This is how I actually cheated on you guys a little bit, because when I was trying to do the as-is valuation of Coke, I had a pretty good idea of what growth rate the market was already looking for Coke by walking into the class, because I already had a sense of what the G the market was using was, because I knew it was 3.65. And so that's what I'm telling you. Staring you right in the face in these multiples that are trading in the marketplace today is a representation for what the market thinks a company is going to grow at. And this is part of what we need to have to understand that we can get from our data. Then, let me go a step further. What is the other ratio that we care about, which is enterprise value to sales, also as enterprise value to revenue? Again, here is the key value driver formula up top. What is enterprise value to sales? Well, I need to do revenue, enterprise value to get that out, to get to NOPLAT, revenue times margin, EBIT times 1 minus the tax rate over revenue. Divide both sides by revenue, margin times 1 minus the tax rate times all this other stuff. 1 minus the tax rate and all this other stuff, this is enterprise value to EBIT. What is enterprise value to sales? It's the profit margin of the firm, which is the operating profit margin, EBIT divided by sales, times the enterprise value to EBIT ratio. So here's the thing. For Coke, their enterprise value to sales on October 7th was 4.4, which meant that the operating margin of Coke had to be 24%. That was the assumption that the market was using. So again, when I was doing the as-is valuation of Coke, I already knew that the market was expecting Coke to grow at about 3 to 4%, and I already knew that they were using a margin of 24% in the future. So I kind of cheated on you guys when I said I didn't read the IBIS report and I didn't read the other data, because to be honest with you, I didn't need to. Because I had a sense of what the pros were pricing Coke at based on the two primary assumptions that are going to matter in our model, which were driven by what I saw in the multiples that day. So let me just give you one other sample of this for IBM. So if enterprise value to sales is margin times value to EBIT, then margin equals enterprise value to sales divided by enterprise value to EBIT. So let's look at IBM right now in Bloomberg. If I go to IBM, US equity, and I go to the RV screen for IBM, and I go to custom, and this is what I'm going to show you how to do on Wednesday, but one of the templates you're going to create is the multiple template, so that Bloomberg will create all these multiples for you, so you don't have to do it again and again and again. But here's the point. Somebody need a calculator? You need a calculator. Specifically, you can do this off a cell phone. I just need you to divide two numbers. Today, IBM's enterprise value to sales is 2.18. So take 2.18 and divide by their enterprise value to EBIT, which is 9.26. What is 2.18 divided by 9.26? 0.235. So 23.5% is the operating margin the market is using on IBM today. So our nice volunteer, that's this line. When you did your valuation of IBM, the market is using 23.5% for these numbers. So here's the thing. When we had to come up with our as-is valuation, we were trying to understand, is the market worried about revenue growth, or is the market worried about margin? Now your story, and I'm not saying it's a wrong story because the market could be wrong, but I'm telling you based on the trading multiples in the market today, what's the market worried about for IBM? To get to the lower share price, you had to either cut the revenue or cut the margin. What if you didn't cut the margin? What would you have to cut further? Revenue. That's the fear factor of IBM and stock today in the marketplace. They're not worried about the margins, because what the CEO of IBM has been doing is she's been slashing cost as revenue hasn't been there. So what she's been doing is she's saying, look, I'm willing to give up revenue for margin to protect my margin. And so what the market is now saying is, if you keep extending that out in the future, you're going to miss out on a lot of growth opportunities. And we're really worried about IBM's ability to grow given that strategy. So really, what the market is slashing is their revenue estimates. They're not really slashing their margin estimates as you go into the out years, right? Because IBM shows them how to make money. Now, I'm not saying that you can't come up with another scenario that differs from that, but that's what's based on the multiples are telling us today. So when I say you have to do a multiples analysis in this class, it's not just go give me 6 numbers, average them out against peers, and say my company has a delta. That's just the beginning. And if you do that, you've just done something that's naive. And if you really want to differentiate yourself as an analyst, you get to the level of detail that I'm going to show you. And by the way, 99.5% of other students in this world at top business schools have never been exposed to the data that I've showed you here today. So if you really want to impress yourself with the banks, this is how you impress yourself with the banks. Because this is what the sophisticated banks are really doing when they do their multiple analysis. Because I can work forwards, I can work backwards. You give me the margin and the growth rate, I'll tell you what the multiple is. You give me the multiple, I'll tell you what the margin and the growth rate is. I got to be able to work comfortable backwards and forwards. And oh, by the way, when I do my cash flow valuation, these should be syncing up. So that's the point. When I'm doing my as is for my group project, I'm telling you that the G that you use in your assumption is right there in plain sight that the market has already given for you by looking at the multiples if you back into it. And the margins and that growth rate you can then manipulate, but at least you have a starting point for the initial assumption, and then it just becomes, do I agree or disagree, buy, sell, hold. Does this make sense? Questions, comments? So we are going to pick up right here during our next class, talk a little bit more about this, and your assignment will be based on that.